shortly. While we wait, please take a moment to fully prepare for the presentation. First, make sure your audio is working. You should be hearing sound now. Also, please remove all distractions. The information we will be sharing is very important, and we want to make sure you get as much out of it as possible. And finally, be sure to have a notepad and pen so that you can easily take notes and write down references that may be discussed. Thanks again for trusting Trade Maestro with your trading education. We will begin shortly. For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting into practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next hot thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was and I just follow their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
It just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable, it's comprehensive, and it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, hello, good afternoon, good morning to some of you. Welcome to Thursday, another great day of building blockchains. I'm your host, Jeremy Whaley, and it's wonderful to be with you today on what was honestly like a Thanksgiving for me. We homeschool our kids, and they have their homeschool groups that they are part of, and they meet every Thursday. And since next Thursday's Thanksgiving, today they had a big feast, and I got to go eat with them. So I'm feeling a little bit, post-Thanksgiving lunch right now. But it's great to be here. And we got a great show today. I think we got some great stuff to talk about for sure. We're going to do a little bit of the traditional stuff, the market updates. A little interesting there. Then I've got some interesting insight for you on the XRP ETFs that I think you're going to want to hear. We're talking about 11 cryptocurrencies to watch. I'm curious what your thoughts are on these cryptos as well. And then for our Crypto Basics and Crypto Alpha, I'm going to actually merge this together, and I'm going to talk a little bit about mindset and trade setups. And it's going to kind of all blend together into one chunk today. So I personally think this is a great show. I think you're going to think it's a great show. With no further ado, let's get the party started. That was exactly how I did not plan for that to go. But you know what? Sometimes you push two buttons at the same time. What can I say? Here's where we are today. It is another ocean of red. Another ocean of red. How many red oceans will we have to cross? Well, I told you yesterday, I think we're probably going to see quite potentially 75,000 on Bitcoin, and we're down to 86 today, down another 5,000 points. Now, compared to where we were just before I left for the lunch, the homeschool meetup that I just told you about, it's been kind of a pretty rough morning. It really has. You can see right here, just kind of fell off a cliff. If I come over to our main chart, you're going to see it in a little bit more action. I'm going to come down to a 5-minute chart so you can really see what happened. And basically between about 9 o'clock this morning, more like 9:30, and 12:30. I mean, that was the move right there. It just boom, the bottom fell out. And it didn't just fall out in crypto, it's happened across the board. If you take a look over at the Dow Jones Industrial Average, that was the move on the Dow today. So stocks are doing the same thing. We were up here early this morning, and then kaboom, the bottom fell out. Actually, it didn't fall out. It just began. There was no bottom that was breaking. Anyway, lots of selling. Down 350 points on the Dow Jones, down 5,000 on Bitcoin, 5,338 right now. And of course, it's across the board on all of the assets today. So everything's down quite a bit. Coming back to a daily chart, coming back over to crypto here, you're going to notice this candlestick, very red, very big. Now, you might think to yourself, well, that's kind of what it looked like yesterday. And you would be kind of right, because it did. This time yesterday when we were looking at these and I was showing you these candles, it literally looked like that. And then you can see by the end of the day, we ended up with a long lower shadow. That was on yesterday's candle. That was yesterday's daily chart. And then today we're repeating it. So this is actually 3 days in a row where we've had big selling, and by the end of the day, everything turned. Will we turn today as well? I don't know. We're going to find out. But the selling pressure is definitely on today. We're seeing a lot of red across the board. And it's not, for better or worse, it's not just Bitcoin. It's all of it. Ethereum dropping below that critical support level that we talked about yesterday. Let's see if the bulls can come back in on that one. XRP, I told you, XRP sub $2. There it is. It's an interesting story too, because we have another ETF going live. But Yeah, there it is. XRP sub $2. Been telling people for months now, or weeks, I should say, that was going to be an opportunity. And XLM, 23 cents. There you go, folks. There you go. 23 cents right back at a support. So will these supports hold? That's obviously the question that yet is to be answered. Solana kind of holding in the support vicinity, but technically on the bottom side of that right now. And we're going to find out as the week continues and as we get into Thanksgiving week next week. All right. So that is my big picture market update. Yeah, maybe not what some of you wanted. I still am of the mind that we're just finishing off a pullback, a little correction. I don't feel like we have major bear market signals yet. I know there's some consummate bears that are out there that are saying that we do. There's people that love to tie it to economic news and all sorts of other things, and I just think that they're missing the big picture. But, you know, whatever. We're all entitled to our opinion, and I just gave you my analysis and my observations of what's going on. All right, so with no further ado, let's talk about some of the headlines and what's happening in the world of crypto news. One of the stories that I continue to see, because we're seeing all of these ETFs coming on board, is I'm continuing to see headlines that are complaining that the ETFs can't support the crypto. And this is another example right here. How high will XRP go after the Bitwise ETF goes live today? So that headline tells you a lot. Bitwise is going live with another XRP ETF. Interestingly enough, they actually got stock ticker symbol XRP. If you guys want to take a moment and go over here and look at that, let's do that. We'll pull up, it should just be XRP. I mean, this is going to be confusing in TradingView because some people be pulling up the ETF when they're trying to pull up the crypto. But nope, that's not it either. See, there's a perfect example. XRP, we don't need the crypto feed. We need the ETF feed now. So where is that? It may not even be in here yet. But it will show up. The point here is that Bitwise is releasing their ETF. So this is what, the third XRP ETF in a week or a week and a half or so. And a lot of excitement about it. But what the headlines continue to publish and what the journalists continue to publish, this is on Coinpedia, is they continue to say, hey, what about these expectations of supply shock? I'm going to highlight it for you right here. Expectations of supply shock. What's going on? Why are we not seeing it? And if you look at a lot of these headlines, people are saying, I don't understand. All these ETFs are coming on board. There's all this buying pressure. They're loading up these ETFs. These ETFs are getting tons of volume. Why are we not seeing it reflected in the crypto? Have any of you guys wondered that? You know, we got volume coming in and out of the Bitcoin ETF. We got volume flooding into these XRP ETFs and Solana and all of them. You notice right here, XRP eyes a week of rebound after a wave 4 dip. As new ETFs and potential inflows this week could fuel a broader demand cycle. Well, guys, this is a fake headline. This headline actually has nothing to do with reality, and I wanted to bring it to your awareness here. This is one of those situations where people are using a piece of news and they're carrying it forward, assuming that it's actually going to have a fundamental impact on the price. And I want you to understand that actually ETFs don't affect the price. It's quite the opposite. The way that ETFs are designed, now this is a spot ETF. There's two different types of ETFs. There's a derivatives-based ETF where they're going to use futures contracts and variations of derivatives, but primarily futures contracts, to basically hedge and estimate the price or the value of the ETF based on what the underlying is. So let me talk about that for a minute. If you have a ETF, an exchange traded fund, that is based on futures, then they never buy the cryptocurrency or anything else that they're using. Like you look at S&P, SPY, for example. You know, they're not buying the index, they're buying index futures. Index futures don't actually have any impact to the price. What do index futures do? They're just simply a derivative that's based on the underlying price. Same thing is true for XRP futures or any other cryptocurrency futures or any other kind of a derivative contract. Derivatives are based on the underlying. They don't impact the price of the underlying. So for somebody to be so naive to say, oh, well, XRP is getting all this money flowing in because they're loading up a ETF, they don't understand how the money flows. Because that money, if it's a derivatives-based ETF, that money doesn't even flow into the currency in any way, shape, or form. It's all based on derivatives. So it's a very naive projection of what they think should happen. But then let's go further. This is a spot ETF. So I'll show you here right on the screen. This is a spot ETF. Now, a spot ETF is a little bit different because in the case of the spot ETF, they actually do hold the spot value of the cryptocurrency. So then people are thinking, oh, see, it's a spot ETF. It's going to create all this buying demand for the cryptocurrency. Actually, no, that also is not how the ETF works. Because what the ETF does is the ETF is designed not as a funding mechanism, but as an exposure mechanism. Let me break that down and explain to you. The exchange traded fund is not designed to create inflow into XRP or into Bitcoin or into Solana or anything else. What the exchange traded fund is designed to do is to mirror the price of the asset that it's holding. Otherwise, what we would have is we would have people dumping money into the ETFs, and the ETFs would then be dumping money into the assets, and the assets would then be going up and down based on how many people are trading the ETFs. Well, that's not how it works. Instead, what happens is behind the scenes on the secondary market, there's a whole other world over here in the world of finance, and you've got big funds, big firms with a lot more money than you and I have combined. And what these firms do is they are buying the spot. They have basically broken it into chunks that get moved into and out of the ETF as needed. And so as more people buy into the exchange traded fund, what they do is they take that money out, they give it over here to the secondary market, and they move stuff over. But always what they're doing is they're managing the price of the ETF to match and to mirror the price of the underlying, whatever that underlying is. In this case, it would be XRP. So it's a really, it just, for somebody to write a headline like this that says, oh, well, we got all this money that's flowing in, you're just revealing what you don't understand about finance. The ETFs do not fund the cryptocurrency. And anybody who says differently doesn't understand how ETFs work. It's just not the case. The way that the ETFs work is they're designed to match and to mirror. So if XRP goes up in value, the XRP ETF will go up in value. If XRP goes down in value, the XRP ETF will go down in value. And it's matching and mirroring the underlying, in this case, the underlying cryptocurrency. It's not manipulating it. Otherwise, we would have these ETFs that were truly manipulating the market. And that's exactly what the headlines are suggesting. You're like, oh, well, why aren't we seeing all this inflow of cash? It should be flowing in. Actually, no, it shouldn't. And you better darn be glad it's not. Otherwise, these funds would have way too much power, way too much influence, and it would kind of be a market-making manipulation disaster. So that's what I wanted to say about ETFs and XRP today, and hopefully that brought some understanding to you about how the inflow of the cash actually happens. Let's take another look at a headline here. 11 cryptocurrencies to watch in November of 2025. This is on cryptonews.com. And I thought I would look at these and get y'all's opinions on them. I have my own opinions, but kind of interesting. Bitcoin Hyper. So you can get some Bitcoin Hyper for just a penny. And it's got a market cap of 28 million, 28.17 million. I'll try to get my pen going here. So Bitcoin Hyper is one that they're saying is a top 11. Maxi Doge, this is definitely one that has gotten some attention, 4.5 million. Look at the price on that. If you want to go pick up something cheap, 0.0002. I mean, you can't get monopoly money that cheap these days. Pepe Node, similar, getting a few $1 million flowing in here. Best Wallet, I'm actually not familiar with that one. I probably should be, but I'm actually not. You can see some of these little Pepe, Space Pay. One I wanted to draw your attention to, Hyperliquid. I really think this one is one you should get your eyes on. It's Hype 8. Hyperliquid, if you're not aware of this, is a decentralized exchange that is just changing the way that DEXs are operated. It is fantastic. And this is a project you definitely want to put your eyes on. If I had to say, which one of these I actually really believe in, that would be one right there. Now, price is a little bit higher. It's worth $39 billion in market cap and $39 per coin right now. So definitely not picking up some penny cryptos here, but that's a good one right there. And then of course Solana, I'm a big fan of Solana, and Bonk and Doge. You're familiar with those guys as well. They're pretty popular. But what do you guys think? Are these the top 11 cryptocurrencies for November of 2025? I'm going to actually say I don't think they are. So you're going to be like, well, what should the top 11 be? Well, if you haven't seen it, I want to actually introduce you to Texit. Texit is one that I personally think is way off the radar. I didn't spell that very well. It's TXCUSD is your chart for this. This is up 4,000% over that since the beginning of the year. I don't know what this glitch is. I don't know if it was a market-making glitch. It could just be corrupt data. I don't know why this glitch is here. Could be auto bots, who knows. But this coin is a fantastic project, one that I have recently gotten more closely aligned with. Very excited about this. And if you look back and see, we're back in the pennies in January of this year, and it is currently at 383 today in the face of a very bearish market, I mind you, 393. Okay, so we got some bullish action on this one today. I don't know what the percentage is on that, but it's like 4,000% in 1 year on a coin that is a level 1 coin. We're not talking about some meme coin. We're talking an actual level 1 crypto blockchain. We peaked up here at, right around $7, at least briefly. And it's natural to have a pullback. I'm not too worried about that. But what this project is, if you're not familiar with Texas, it's based in Texas. All of it is taking place in Texas. They're actually mining real crypto. They're building the world's largest privately funded mine in the world. And it is a fantastic project with real people behind it, real use case, real stablecoin L2 token case. This is actually one you should get your eyes on if you haven't done so. So talk about the top 11 coins for November of 2025. Texit. Right here. Get your eyes on Texit, TXC USD. You can buy it on multiple exchanges. It's not on the big ones yet, but DexTrade. I think I heard a rumor about Kraken. I don't think it's on Kraken yet, but I think I heard a rumor about Kraken. But you've got several smaller exchanges like MEXC and a few others that are trading it. They're probably on 8 or 10 exchanges. And this is mark my words right now, November 20th, 2025, a year from now, this coin will be at least, I'm going to say 4x, minimum 4x. I don't know. That's my forecast. We'll see. I'm going to continue doing more research on it, and I'll share more with you guys as I look into it more. But this is a project that I think should have been on this list right here. So the jokes on crypto news, no, I don't think those are the top 11 coins for 2025, personally. But hey, we're all entitled to our opinions, right? All right, folks, let me know what you think. Give me some feedback here in the chat and in the comments, and tell me what's your favorite coin. Show me your favorite coin. What's your favorite meme coin? What's your favorite L1 coin? What's your favorite right now? Let me know. With no further ado, let's get into our crypto basics. I like these little transitions. They're kind of groovy. They don't always work just the way I want them to, but they're pretty cool. All right. I want to talk about what separates a professional trader from everybody else. What separates professional traders from everybody else? And this is really setting us up for a conversation that I want to have on trading mindset and discipline. And every week I'm going to try to do at least one show committed to mindset and the inner game of trading, because the reality is, most people, they'll spend 99% of their effort trying to figure out the value of a coin, trying to research it. Is this a trade that I really want to get into? What's the market cap? What's the circulating supply? They're looking at all these numbers that are out there, most of which actually aren't impacting the current value. And they use that to create a narrative in their own mind of what they should and they shouldn't buy. And they'll put, 90 to 100% of their effort into that process. And the reality is about 90% of trading is mindset. It actually has very little to do with the analysis, very little to do with all the other stuff that people put their attention into. And so I'm really going to try to, as part of our Building Blockchain series, I'm really going to try to focus in on some of the inner game of trading and bring a lot of that to you. And I want your all's feedback as well. I'm curious what you struggle with, what some of the the little emotional saboteurs are that show up for you. So, give me feedback on those. But today I want to get into that question. What is it that separates professional traders from everybody else? And I can answer it really quickly. And here's the answer. You ready? Discipline and risk management. The truth is professional traders as a whole suck. That's just the truth. I mean, I'm going to be really candid with you. If you look at the statistics, I don't have it in front of us right now, but if you look at the SPIVA study that S&P Global does, it's the S&P, it's Standard & Poor's. S&P Global's been doing this for 20 plus years, and they go back and they look at all the professional funds that are managed, and they compare it to what if they were to just buy the S&P 500. And consistently, I've been tracking this study since 2015, so 10 years that I've been tracking it, but it's been going on even before that. And consistently, here's what you see. Within about a 1 year period of time, roughly about 40 to 50% of funds match the S&P 500 or beat it a little bit. So about half. Okay, it's not too bad. You would think over time it would get better, right? It's actually the opposite. Over a 3 to 5 year period of time, that number drops substantially, and it's about 60 to 70% of funds that cannot match or beat the S&P 500. So now we're down to okay, the top 30% are good, the bottom 70% are bad. You go another 10 years, the numbers get even worse, and it's about 85% of professionally managed funds cannot match the S&P 500. You go 20 years, and it gets even worse. It's more than 90%. And depending on the year of the study and how everything averaged out, I've seen it as high as 96%. Normally, it hovers around 92 to 94% of professionally managed funds cannot match or beat the S&P 500. So the professionals suck at their job. That's what the statistics show. And that's over a 20-year period of time. Now, if unless you've been living under a rock, you've been hearing your whole life, you need to put your money in the market, let the guys manage it for a long period of time. You shouldn't even look at it for 10, 15 years. And this study shows the exact opposite. This study shows that the longer the so-called professionals are managing your money, the worse they do with it. That's what the studies show. So what do you do with that information? Do you say, well, professionals suck at their job and I'm just going to do it myself? Well, honestly, I think that's actually a really good answer. But the challenge then becomes, why is it that the professionals keep their job and statistically speaking, amateurs go broke? And the answer is right here: discipline and risk management. The one edge that professionals have that amateurs don't have is they follow their trading plan and they're disciplined, whereas amateurs tend to be very reckless with their trades. And the result is that amateurs see wild volatility, they're chasing on emotion, they're doing all sorts of things that the professional trader actually isn't doing. And it's those little things that keep the professional trader from completely going broke. It allows them to keep their job and it allows them to continue showing up year after year, being mediocre, but actually having a career, whereas most amateur traders wash out. So let's look at some of these differences right now. Amateur traders just go with the flow. Amateur traders don't really have a plan. They tend to just go with the flow. Whatever's popular in the media right now, that gets their attention quickly. Sometimes it's a news story. Sometimes it's a headline. Sometimes it's the taxi cab driver or the Uber driver. But they go with popular society. They're driven by hype. They're part of the herd. Their plans can change very, very quickly. They're very emotional with their trades. They take irrational risks, and they tend to blow accounts out very frequently. Now, if you don't believe that this happens in crypto, then you've been living under a rock. If you don't believe it happens in stock, you've been living under a boulder. I mean, this has been known for decades. And one of the things that's drawn me into this marketplace right now is the fact that I'm looking all over Twitter, X, and I look over social media on Telegram, wherever, and I see these traders who, 6 months ago were boasting brand new Lambos and, they made 1,000,000%, and they took $1,000 or $10,000 and they're sitting on seven figures. And I just looked at one yesterday The guy revealed everything. He lost everything, and he's like, I'm out. I'm out. He made all this money. He over leveraged, and he lost it all. And he was pushing at one point almost $10 million that he had made over the last couple of years. Now, that's life-changing money both directions. If you've never made $10 million, you don't know how much it can change your life. And if you've never lost $10 million, let me just tell you, it changes your life to the negative. It's the kind of money that makes people do really bad, harmful things to themselves and question their existence. Like, how did I do this? And I know if you're sitting there on the other side right now, there's a good chance you're thinking, well, geez, if I had 7 figures, I wouldn't lose it. Well, I'm here to tell you, I have made more money and lost more money than most people will make in a couple of lifetimes. And I also said the same thing on the other side, right? So, it's easy to judge from the outside, but until you're in the situation, you don't realize how fast things can change. And they can change very, very quickly. And what we're seeing with amateur traders, especially in crypto, is all of these characteristics that have historically always been there for stock traders are just amplified. We have a whole new group of Gen Z, and now we're starting to get Gen Alpha, but Gen Z and some millennials that they don't have any of the experience that baby boomers and Gen Xers had in the market. They don't have these market boom and bust cycles. All they've known is crypto, and all they've known is you buy and hold Bitcoin, and it's going to go up, and it's going to go up fantastic. And all they've known is we buy some Dogecoin for a few pennies and you can be a Dogecoin millionaire. And they know the crypto millions, but they don't understand the emotional side of it. They don't know the ups and downs. So wherever you fit into the spectrum, for some of you, you're one of the younger generations, and hopefully you're hearing the warning signals from me. For others of you, maybe an older generation, and you're still trying to figure it out, and you also need to hear the warning signals. Okay, it's like, did you ever see those demotivators? If you're old enough, and some of you are not, but back in the 90s, back in my day, kids, back in the 90s, there were these stores in the mall called Successories. I don't know if you guys ever saw those, but they had like these success posters and all these little gifts that had motivational quotes and stuff on it. And we used to kind of make fun of them because, well, we were young and that's what young people did. But there was another group that came out called Demotivators. And it basically was a parody of Successories. And they would do these posters, and they were the opposite of Successories. It would be things like, it would be a shipwreck, for example. And it would say the purpose of some people's life is to simply serve as a warning for others. And that's how I feel sometimes. I feel like sometimes the ups and downs that I've experienced are here as a warning for others. But the thing is, you have to be willing to hear and to see the warning signs that some of us have gone through. I've often joked, we talk about people having scars on their back. Well, if you could see my emotional trading scars, I've said that my back looks like Jack Bauer. It's totally beat up, right? Because of all the ups and downs we've been through. So I'm telling you this just to say, I speak from experience, and I speak from a lot of painful experience, a lot of really great experiences, and hopefully you'll take some of these lessons. So let's recap this and we'll move right along. So amateur traders tend to go with the flow, driven by hype, change plans quickly, super emotional, irrational risk, blowout accounts often. Compare that with a professional trader. Instead of going with the flow, the professional trader has limits. They have boundaries. They set up from the beginning with boundaries. One of the reasons that professional traders sometimes struggle to match the S&P is because the S&P 500 exceeds their boundaries. It exceeds their limits. They couldn't match or beat it if they had to, because the boundaries that are set up are so tight that they don't have that much volatility, that much flexibility. So that's one of the factors of professional traders, is they have limits. They're not driven by hype, they're driven by process. This is such an important thing to understand. Professional traders have a process, they have a flow, and that's what drives them. They follow their plan, and the reason they follow their plan is because they get fired if they don't. All right, let that sink in. Imagine if you're trading your crypto account or your stock trading account, and you just suddenly decide, I'm going rogue. I'm not going to follow my plan. I think I know better than my plan. And then you lose some money. Imagine if somebody was sitting over your shoulder and said, you did what? You're out. Can't trade anymore because you broke your plan. Professional traders know better. They follow their plan. They have emotional guardrails in place. They take very calculated risks. Their trade setups are calculated. They know what their risk is. They know what their reward is going to be. And they execute those plans. And then they analyze on the backside if that was a good plan or not. And this is how professional traders operate. It's also the way that I operate now. Even though I'm not considered a professional trader, I would technically be considered what we would call a retail trader, or some would call an amateur. But my 20 years experience in the market, the fact that I haven't blown out account in almost 2 decades now, I think is personal experience enough to say that, I've moved over. I'm no longer an amateur trader, but I don't trade for a firm. I just trade my own money the same way that I teach other people to do it. And what I have found is when you adopt the same patterns and the same systems and processes as the professionals, sometimes you beat the S&P, sometimes you don't. But you know what you can definitely do? You can live to trade another day. You can keep your money intact, and you might discover that the risk management piece was actually way more important than you ever realized, especially that younger, less mature version of yourself. So with that in mind, let's talk a little bit about the trading plan. And I want to show you how I set up a trading plan. And I don't make trading plans complicated. Years ago, I had a student that found us at a live conference that we were doing. And he was so excited, he wanted to sit down and share his trading plans. And he'd written a whole manual on his trading plan. And we sat down, and his trading plan, his plan was like 85 pages, and I'm not even joking, of contingencies. If this happens, then this. If this happens, then this. If this happens, then this. And I looked at it, and I was like, that's really admirable, but nobody can follow that. Like, you can't work through 85 pages of a trading plan. A trading plan needs to be so simple that you can understand it at a glance. It needs to be so simple that even if you're not looking at the plan on paper in front of you, you have a pretty good idea of what your plan is. It needs to be so straightforward that even if all you have in front of you is your price chart or your memory, you can execute or come very, very close to executing your plan. That's how simple a trading plan needs to be. Now, there's all sorts of variables that you can get into. You could get into different data points that you'll take in. You could get into different scaling variables. And if you're doing options or futures, you could get into different hedging techniques and strategies. There's all sorts of variables that you could get into. But at the end of the day, a trading plan comes down to 3 things, and it is these 3 price points. And anybody who trades without these 3 price points has not had a trading plan. Okay, so let me ask you before we get started, just you can answer in your own mind. When you place a trade, do you have a plan? That's the first question. And if your response is, yeah, I got a plan, then my next question is going to be, what is it? What is your plan? If you say, no, I don't have a plan, then my first response to you is, then you're planning to lose. It's that simple. If you go into a trade and you don't have a plan, then you're planning to lose, because the market is not very forgiving to people without a plan. And before I get into these 3 price points, I want to talk about that for a brief moment. Up until now, for the first 15 years of crypto has been remarkably forgiving to people, for better or worse. People could just simply buy and hodl, and they tended to get rewarded for really not a very good trading plan. It tended to be that they could buy some Bitcoin. If they hold it long enough and they hodl through the drawdowns, they're going to get rewarded. And that became the strategy. Like, that was the technique. What's your plan for crypto? I'm going to buy as much as I can. I'm going to hold it forever. Okay, cool. Well, then here's what's happened over the years. What's happened over the years is more and more people have taken awareness of it. They've gotten involved. And as the volume has increased, as the trading activity has increased in the world of crypto, the other thing that has increased is market, we'll just call it discipline. Market discipline, where trades move up to a support level, up to a resistance level, back down to a support. They tend to be more patterned in the trading behavior. And the higher the volume of popular society is in the trades, the more disciplined and the more predictable the price action becomes. Why am I saying this? Because as volume floods into crypto, as Bitcoin moves from being this outside asset to this asset that now every major hedge fund and every investment house in the world is becoming part of, and CFOs are jumping into it, and people who used to say never crypto are suddenly saying got a crypto. As we move into that phase of the crypto revolution, what you're going to start to see is cryptocurrency price action starts to look a lot more like stock market price action. It becomes a lot less forgiving. It will punish the market participants a whole lot more for irresponsible behavior, we'll call it. And you will not be able to get away with some of the things that you used to get away with. And so it's a very important lesson to understand that if your strategy for buying crypto has simply been buy it and hold it indefinitely, that strategy is not going to work indefinitely. You've got to, at some point, learn a real trading strategy and a real understanding for trading plans. So with that as a preamble, a very long preamble, let me break down the 3 key price points that every trading plan needs. And the first one is this: you have to know your entry price. You have to know your entry price. You have to know your target price, and you have to know your stop. If you do not know these 3 price points, guess what? You do not have a trading plan. Your basic trading plan is buy and hope. Buy, hold, and hope. And that is not a trading plan. Now, as you're thinking through this, as you're listening to me, how many of you can honestly say your trading plan has kind of been a buy, hold, and hope? You take whatever hot crypto picks somebody gives you, you try to do some analysis on it. And if you're really honest with yourself, it wasn't very good analysis. And you hold it and you're like, I'm just going to buy this thing and we're on the rocket ship. Let's see where this thing goes. To the moon. That's where most crypto traders have been. But I can't get away with that in the world of stock market. And where you really can't get away with it is in futures and Forex trading. If you're a Forex trader and you're trading with 100-to-1 leverage and you're trading bullish and bearish setups, and you try to have that philosophy of I'm just going to buy and hold and hope, you'll be flushed out before you can sneeze. I mean, it will happen so quickly to you. That's why people stopped trading Forex. They weren't really good traders. They didn't know what to do. There's nothing wrong with Forex. Forex is a great market. There's plenty of trading opportunities in Forex, but you have to be disciplined. You have to know what you're doing because there's leverage involved. And what I'm seeing happen in the world of crypto right now is a lot of the same patterns that we saw happen in early Forex trading, where people got into it, made a lot of money, didn't really know what they were doing, and then they washed right out because they didn't really know what they were doing. And the worst thing that can happen to you, I'm going to be honest, the worst thing that can happen to you in trading is as soon as you start trading, you see success. I know that sounds mean, but it's about the worst thing that can happen because you believe the press in your own mind. You start to think, I really know what I'm doing. Wow, this is really easy. I know exactly what I'm doing. I'm smarter than all these other people that have been in the market for 30 years. What do they not know? I mean, this is easy. Hang on. Just hang on, because those of us who've been in the market for 30 years, we've ridden those cycles. And I've traded through a financial collapse of 2008, and I've traded through a COVID, and I've traded through these market crashes that wipe out most people. And you say, I'll just hodl through it. Eventually, hodl doesn't work. I traded through the Zoom boom of 2020 when the price went from, whatever it was, 50, 60 bucks a share. I can tell you more specifically, market cap. It was like $1 billion market cap, goes to a $4 billion market cap, and then it collapses. And it never came back, even though they never canceled the accounts. It has more recurring revenue, like 10 times more recurring revenue today than it had pre-COVID, but we're back at pre-COVID prices. Makes no sense because fundamentals don't actually matter. And one day you'll learn that story. One day you'll learn that reality of how the market works. But until you learn that, if you can just adopt a discipline and you can just learn to say, you know what, it doesn't matter what I know or don't know. If I can just manage my risk, if I can just be disciplined, then what you're going to find is you actually live to trade another day. And the most important discipline that you can adopt is this one right here. When you get into a trade, before you execute the trade, know your entry price. Know what price you're going to buy the trade at. Know where you're going to get out for a profit and know where you're going to get out if the trade goes against you. And then you're never taken by surprise. And once you have those 3 key price points, now you can actually build a trading plan. You know your risk. You know your reward. You know exactly what you're getting into. Most traders never go there. So let me show you how it works. You've been learning about these trade setups all week. We've been talking about support and resistance. And I've showed you several situations that kind of look like this, where a price action comes down to a support level and it starts to build. Okay, now this is exactly what we're seeing right now in the crypto market, right? So we got all sorts of crypto that looks about like this. The price sold off big time. News media says, oh, it's a crash, it's a crash. If you zoom out, you're like, oh, it's a consolidation. It's at a support level. Now the question is, do I buy? Well, the naive trader and somebody who might have traded with like 1970s philosophy would say, yeah, you buy as soon as you get to support. You're going to buy on the dip. There's just one problem with buying on the dip. When you buy on the dip, a lot of times you're the person who's buying while more people are liquidating on the way down. You see, right before this price action crashes, it's going to look like that. And I don't know yet which way it's going. I don't know if it's going to trade back up, and I don't know if it's going to trade down. So why would I buy when, statistically speaking, I don't have any good probabilities in my direction? I can look at moving averages, I can look at indicators, I can look at all the different analysis, and at the end of the day, I can't come up with a probable direction where I think this trade should go. So while most people are like, hey, it got back to support, start buying, I'm like, no. I say no. I learned this from a Forex trader who taught me this. Said, wait until it bounces. And when it bounces, that's where we get into the trade. So when I do trade setups, I almost always do a trade setup like this right here. After it hits support and bounces. When it trades back up, I'm going to get in on the uptick. Now, that's counterintuitive to a lot of traders. They're like, oh, but that's more expensive. You should get it while it's cheap. I know. But this one puts probabilities on my side. If I try to get in while it's cheap, I end up with a failure rate of 60, 70, or 80% of your trades. If I wait until it's moving in my direction, I flip that probability and I end up winning 50, 60, 70% of my trades just because of this one move. Wait until it hits support and bounces. That's where your entry price goes. So now you put your entry in there. You say, that's where I'm getting into the trade. You say, where am I going to trade it to? Well, I'm going to look to the left. I'm going to see my last pivot point. I'm going to see my last resistance line. And that becomes my new target. Say, but what if it goes higher? What if? We're trading probabilities here. I'm not here to say I jumped on a rocket ship and we traded it to the moon. Sometimes we do that. Sometimes, and there's other techniques that I can teach you later of how we do that. But the most important thing is predictability. The reason most people wash out is because they can't handle the volatility and they can't handle the lack of predictability. So what if we construct our trade setup so that after we hit support and we start to bounce, that's when we're going to get into the trade? That puts the probabilities further on our side. And what if we say when we get to a known resistance level where a lot of people sell, I'm going to just go ahead and take my profit? That's a great idea. That's a fantastic idea. In fact, that's the reason resistance shows up, because there's other more professional traders who did a trade setup and they targeted that same price point and they said, when we get there, I'm taking my profit. So if I were you, I would maybe consider thinking about, when I get there, should I take my profit? I think I'll take some profit. And that's where your target comes in. Now, here's what very few traders ever think about. What are the probabilities of making money with a trade? When you place a trade, if you just go on pure statistical probabilities, you throw a dart at any list of stocks on the big board, you throw a dart at any list of cryptocurrencies, what are your odds of making money? Most of you are going to say 50-50. Wrong. The odds are 33%, especially if you're trading options, because options have a time component as well. But you have a 33% chance that this trade will go up. You have a 33% chance that the trade will stay stuck where it is, and you have a 33% chance that the trade will go down. Now, if the trade goes up and you bought it, you're going to make a profit. If the trade stays the same price, you will lose out on opportunity cost because you weren't able to put that money somewhere else. You may or may not lose actual money, but you'll lose opportunity. And then if the trade goes down, obviously you're losing money. So you have a 33% chance of getting into a trade and it makes money for you. Here's my question for you. The last time you placed a trade, how many of you, the first thought in your mind was, I have a 66% chance of not making money? I've been doing this for a long time. I've been teaching people this lesson for a long time. And the answer is almost inevitably, never thought of that. Yeah, most traders don't think of that. Before you get into the trade, it would behoove you to say to yourself, I have a 66% chance of losing money, and I only have a 33% chance of making money. Therefore, I should probably plan for my loss. That one shift will change everything for you. It may not give you more winning trades, but it will keep you in the game. It will prevent you from blowing out your trading account. That guy that I saw on X, I can't remember his name, but I sure wish I could coach him. In fact, that was, some of you don't know this story, but I'll tell you really quickly. The first person I coached in the world of crypto that really actually got me into crypto, I was coaching on stocks and options, and I owned a little XRP, and I had a little Ethereum and Bitcoin, but I really hadn't gotten into crypto. And this guy was from Dubai, Abu Dhabi, and he reached out, and he had made over 7 figures with Bitcoin, and then lost it. And he was devastated. He didn't know what to do. And he finally, he was Googling trading coaching, and he found me. And I started teaching him this. He'd never heard it before, because in the world of crypto, this is not popular. But what I'm teaching is how a professional thinks about their trades. The professional doesn't go into the trade saying, I'm going to buy and hodl and let's see what happens. That's called gambling. What a professional does is they look at their trade, they say, I know where I'm going to get in, I know where I'm going to take my profit, and most importantly, I know where I'm going to get out if things go against me. And no one's going to make me move that. Now, once you have those 3 price points, we can factor everything off of that. Once you have the entry, your target, and a stop, now we can define what we call your risk and your reward. And the way that we define that is simple. The difference in your entry price and your target. Let's say your entry price is $100 and your stop is $90, and your target is $130. The difference in your target and your entry in this example would be $30. That is your expected reward. If you trade, in the case of shares, if you trade 1,000 shares, that means it's a $30,000 reward. If you're trading 1,000 tokens, and this is the numbers, or coins, then it would be a $30,000 reward. You have to, based on the number of units, you can do the math. But let's just say your entry price is 100, your target price is 130, and if you go in at the entry price and you get out at your target, you're going to make $30 a coin, or $30 a share, or whatever 30 pips, whatever it is that you're trading. Because see, when you learn crypto, when you learn any of these markets, they're all the same. That's the other thing people don't realize. Oh, well, I want to trade futures. That's the best market. Just learn to trade. Just learn to trade. I don't care if you learn stock. I don't care if you learn options. Just learn to trade. Because when you learn one market, 90% of it carries over to the next market. Like, it's not hard. And they're all basically the same. I mean, I can trade futures, Forex, crypto, it doesn't matter. They're all the same. And the same is true for you. And every one of them, I treat it the same way. So the difference in your target and your entry, that's going to be your reward. And the difference in your entry and your stop, that's going to be your risk. Now, if you go into the trade and you know this, everything is like a decision now. Instead of looking at it as hope, instead of looking at it as gambling, instead of wishful thinking, instead of hodling, it's a plan. We have real numbers in front of us. If I go in at 100 and it goes to 130, I make $30 a share or $30 a coin. If I go in at 100 and I get out at 90, it dropped below my support, it no longer looks interesting to me, I get out, I lose $10 a coin. There's my risk, there's my reward. You say, well, I put $100 in, that's my risk. No, your risk is where you're going to get out. Just because a trade goes down doesn't mean you lost $100. Just because you put $100 in, that doesn't mean that's your risk. I mean, unless it just goes to zero overnight, but the odds of that happening are almost zero. Sometimes it happens, but it's very, very rare. If you put in $100 a coin or you put in $100 a share, the chances of that going to zero tomorrow, very, very low. So that's not really your risk. Your risk is the difference of when you get in and where you get out. In this example, it's $10. Now, you're also going to notice on here that the way I've constructed this, there's a $3 reward for every $1 at risk. This is another secret of professional traders, to always have a higher reward than we have risk on the table. And I'll go into that later in another future lesson, but you need to have a higher reward than the risk that you're taking. And if you do that consistently over time, you'll start to see your equity curve going up. You'll start to see your trading account going up. You won't have these wild volatilities. And it has nothing to do with picking the better crypto. It has nothing to do with picking a better trade. It has everything to do with you. What I love and hate in these headlines that I see these days is everything's, this crypto bear, it's wiping people out. Why? Why should a crypto bear market wipe anybody out? Why should a stock market bear market wipe anybody out? Are you so cowardice that you can't just sell and wait? Like you just gotta be in, you just gotta invest your money and let it sit there and ride the down wave. Oh, I'm in for the adventure. I'm gonna hodl all the way through. Be a disciplined trader. The disciplined trader only places a trade that fits their plan. The disciplined trader sees their plan to the end and they trust their plan and they are not moved by emotion. And what ends up happening is instead of having these wild emotional swings, instead of living in this fear that I've picked the wrong trade, I picked the wrong crypto, instead of that, you can sleep at night. You have boundaries. You're evolving. You're maturing. You're becoming a trader instead of a gambler, a trader instead of a hodler, somebody who can actually make money with the swings. And the truth is, that's what the market's about. The market, whoever sold this lie that you should just buy and hold forever, they really need to be strung up by their you-know-whats, because they really let a lot of people down. They led people down a bad road. And I can tell you some of the history goes all the way back to the Great Depression. Because if you were around in the Great Depression, the idea of buying long and selling short, that was pretty commonplace. Like a lot of people did that. And they blamed, erroneously, but they blamed the short sellers for crashing the market in 1929. So, of course, the government gets involved and they pass some laws and they say that, we shouldn't have everyday Bob and Joe able to just go out and short the market. And so they kind of tried to put some boundaries on it. And then they really put boundaries around fund managers. And they said, if you're managing money for people, they don't need to ever short the market. And what they tried to do is artificially create a buy and hold, which would suck up the supply, and therefore creating a longer term bubble, if you will. It's actually not the way it should work. And because the regulations along the lines there, because the regulations came into place and the fund managers who wanted to solicit funds to trade, because they couldn't short, they just told people, you need to just buy and hold for 20 years. Yeah, I should be in this job for about 20 years. Yeah, you should buy and hold for 20 years. And they never actually taught people how trading works. So I'm teaching you how trading works. Trading, if you're a professional trader, is a disciplined adventure. When you get into the trade, you know when you're getting in, you know when you're going to get out. You follow your trading plan. Professionals follow their trading plan. And then let's talk about the risk piece of this. Before you ever get into a trade, mentally, you have to know what your risk is. You have to know what your risk is. If you're placing a trade at $100 and you know you're going to get out if it goes down to 90, that's your $10 per coin risk. You got to know that. If you don't know that, you will be second guessing, and every market tick to the downside, every time it ticks down, every time you're like, oh, should I get out? Should I sell? Should I hodl? What should I do? What should I do? And all your emotions are stirring up. And guess what? Anytime emotions stirring up, that's not being disciplined. You can't trust your emotions in the middle of a trade. I'm sorry. You just can't. You can't trust just intuition in the middle of a trade. You just can't do it. People buy on emotion. They sell on emotion. Then they justify in hindsight with logic, and that's usually rarely a good situation. So before you get into the trade, have the discipline to know your risk. And then people aren't going to like it when I say this, but you have to plan to lose. I've already given you the statistics. 66% of the time, the trade is stacked against you. So you have to plan. If you're going for statistics, you have to plan, how do I make money with the 33%? What if all I do is trade basic market odds and I only make money on one out of every 3 trades? Well, I got to plan for that. And so you got to plan your losses. And then when the losses come, you can't be emotional about it. You're like, oh, well, it happened. Before the trade ever executes, you must be comfortable without loss. And if you're sitting there and you're saying, if this trade enters here and it stops out here and I lose $1,000, there goes my mortgage. If I lose $1,000, my spouse is going to chop my head off. If you have all that kind of emotion wrapped into a loss, you have no business trading. If you can't afford to lose that money before you place the trade, you have no business placing the trade. Don't do it. Because if you can't afford the loss, I guarantee you, in the middle of a drawdown, you will make an emotional decision. It will almost always be the wrong decision, and it will end up costing you. That's the inner game of trading. That's the emotional intelligence that you have to develop. But on the flip side of it, if you'll develop that, if you'll go into the trade knowing your plan, if you go into the trade knowing your risk, you know your reward, you know that if you make a trade, you're going to win $3 to every dollar that you lose. You know that if you do lose, you've planned for that. You've built that into your system. If you know this going in, then when a losing trade shows up, do you get upset? I'm going to be honest. Yeah, it's never fun. There's never a time that you have a losing trade. You're like, yeah, it was fun. But you don't get emotional and you don't get pissed. And you're not like, because you're like, well, I know my odds. I know my statistics. And that one was going to happen. Next. And you can stay emotionally even. You can stay emotionally stable. And that's how you become a consistently profitable trader. All right? So if you'll adopt this mindset, if you'll adopt this discipline, then I promise you, you can be just as successful as professional traders. Do it at home. You can do it in your underwear in your living room. I don't care. I just want you to be disciplined, and I want you to be good. All right, let me know what you think about this. If you want to learn more, you can visit me over at trademaestro.com. Trademaestro.com is what we've been teaching for years. I would love to help you on your journey as well. If you haven't followed already, please like and subscribe over on YouTube. Follow me over on Rumble at Trade Maestro for both of those. Real Trade Maestro over on Telegram. Trade Maestro Official over on Facebook. Trade Maestro Official. All right. Thank you for being here today, folks. Tomorrow, I'm going to be getting into some trader tools. Got some cool stuff we're going to talk about tomorrow. So we'll be here same time, same place, 1 o'clock Central Time, 2 o'clock if you're in the East Coast, noon in the mountains, 11 o'clock if you're still over on the Pacific Coast. All right. Until then, I wish you the best. Happy trading to all of you. We'll see you tomorrow.